Good morning, all. Thank you very much for the warm welcome, Alan. As you said, some of you may know me, some of you may not. So before I speak to you some of the key areas of what we're doing, what we're seeing in the current environment, I will just give everyone a touch of background. Alan said myself and Frank and James are the key members of the CC Property business. We come from banking backgrounds. The three of us collectively used to work on a portfolio in ANZ. In that time, I was responsible for credit underwriting, credit oversight, worked through the research and analysis functions of the institutional business, both domestically and internationally. My last role was in Singapore before coming home to Sydney and starting this business. In this business, we undertake our own development activities, project management. We outsource the credit skills that we work with Zagga, and we continue to deal with property every day, all day through various functions, including the advisory piece. So for anyone who wants to know more about that, I'm happy to speak to that. In the development side of things, we just recently completed 43 apartments as developers in project management. That's included getting DAs for 280 lot subdivisions, for working on high density sites in the inner city. So I won't go into too much detail on that, but just to give everyone a touch of background about what we do, there's that. Obviously, we're in very interesting times in the property market and things are evolving every day. Like all of you, we're trying to keep a very close handle on what that translates to and what that means for both property assets in the sense of value and for how the loan book and lending needs to be covered and risk needs to be mitigated on a continual basis. So what we've seen since the pandemic has come into play is a tightened availability of debt capital with reduced gearing and risk appetite in the market. That tightened availability has been substantial. We've seen a large number of institutional players, high net worth players, all looking to remove their capital from the market, or if they are going to continue using it, it's going to be on substantially different terms to what it was pre-pandemic as they take a cautious approach, which is understandable. We've been doing the same thing. Many players have been reducing their limits and pricing transactions higher for ones they do. When I talk about players, an example that you may be familiar with is Latrobe. Latrobe was previously doing $25 million construction limits. That's now reduced to $2 million until they see what's going to happen throughout the next 6 months. So some of those players are taking that action. What we have seen is many occasional non-bank lenders and institutions retreating to their core business and closing their lending platforms. So we've seen a number of participants exit the marketplace. What we're seeing with the established and dedicated shops such as Zagga, everyone is gearing to participate opportunistically and at the back end of the cycle when the uncertainty continues to remove itself and people feel more comfortable about what the way forward will look like. Pardon me. Sorry, I just had a phone call come through. In the sense of distress, we're not seeing the distress come through the marketplace right now, although it's something that's frequently spoken of with the stimulus measures which have been implemented by the government. There's been a lot of runway provided for asset owners, lenders, and mortgagees and borrowers making repayments. So as yet, although we're all well aware that distress is a function of the market, if things continue to get worse, we're not actually seeing that in the marketplace day to day. With respect to valuations, the Australian Property Institute has issued a directive that valuers are to complete valuers on pre-pandemic basis with the right to revalue those properties in 6 months. The basis of that is effectively that for a valuer to complete their valuation as they're supposed to, there should be a factual sale on the way into a market and a factual sale on the way out of the market. We don't have enough qualitative data yet which can be relied upon to make informed decisions about whether or not any value erosion has occurred or whether this is a blip and the markets will recover and go back to where they were. So without time, valuers will continue to rely on that directive. That's been accepted by all four of the major banks. Banks are telling valuers that they should look to extend the selling period of time on valuations as opposed to reduce any values. Quantity surveyors are taking a similar view and function that's being driven by their PI insurers, where they're extending building terms. Now, in the marketplace, we haven't seen builders or construction sites actually need to extend terms right now because sites have been considered an essential service by the government and they've been opened up 7 days a week and through public holidays. However, the insurers are taking the approach with quantity surveyors. If you thought it was a 12-month building term, please allow 15 months as a working example. There is still a natural tendency for conservatism, and that will be prevalent from valuers in what you see. And certainly ourselves and the Zagga team are very sensitive to this. And anything that we think is worthwhile transacting in this current marketplace will have been stress tested extremely diligently to make sure that we think those values can withstand the current marketplace. The actions which we're taking in our reviews is a very measured response where we're looking to minimize risk and actively work with our borrowers to protect the capital that you've got invested and the equity which they've got as well in the deal. The way that we can do that is to review the key touch points of every file. This could look at examples of the pre-sales, understanding where the valuers are at with those pre-sales, understanding where finance approvals are, what the banking appetite looks like. Are tenants continuing to pay their rent? Have they had to let anyone off and go on the government subsidies? Is the lease commitment still in place? Any lease extensions? What do those incentives look like in the current marketplace? What demand is there? Are interest payments going to be made, or are they looking for extensions of time to do those in term? And if there's a revaluation required, what that may look like in excess of a stress test. We're staying very close to the industry. We want to be aware of any systemic risk which may appear. Again, that's going back to talking to our key consultants. So we still speak with a lot of bankers who we previously worked with to understand what's happening in the major institutions. We talk to valuers and quantity surveyors every day. We're out on building sites talking to builders and project managers, and we're obviously dealing with lawyers and accountants from the finance perspective. So we're staying close to those people. We're monitoring any legislative updates and other government announcements and how they may impact us and the business. And we're prioritising liquidity management and existing clients over new lending opportunities. The last thing that we would do is overcommit any credit in the current marketplace. The initiatives which we're taking in credit, as I've touched on, is stress testing all new assets to make sure that they can withstand current market conditions. If we've got near-term expiries or loan extensions which need to be put into place, we're looking to increase our security coverage on loans. That could be by capturing cash flows that sit inside or outside of the group currently that we do not hold, taking second mortgage positions against other assets in the group to increase our coverage, anything that we can do to protect ourselves and the borrower, make sure that whilst we manage them through this process, we protect risk and minimise it. Increasing deal tenors in periods of interest capitalisation is another way of giving runway, protecting against default risk, making sure that any term which we have may have a period of time which is conducive to current market conditions, and we allow for that in any gearing. We're backing experienced sponsors, looking for people where they've got multiple exits, multiple assets and experience on the board so that they know how to navigate through things and we can navigate them together. The things that we're not doing, we're not lending to sectors and asset classes with high volatility. Examples of this would be student accommodation, hospitality assets, pubs, clubs, retail assets. Those are just no-go zones for us right now while there's too much uncertainty in the marketplace and how that will play out. We're not taking on leasing and tenancy risk, which are attached to commercial and industrial properties. There may be a number of commercial assets which are already on the book, and we'll do what we need to manage those positions and make sure that the borrowers get through. But we're not looking to take any risk around pre-leasing or new leasing risk attached to those properties right now. We're not negotiating with anyone on gearing levels. We know where those levels need to be set and what needs to be done to protect us. So there's no negotiation there. And we're not leaving it for borrowers to prepare their exit strategies. We're talking about all of this internally on each file to make sure that we've got a plan which is well in advance of expiry and we can execute on that strategy as and when we need to. What we're continuing to do, we're proactively managing every investment. We're methodically working through the amount of inquiry which continues to come, and we need to run that process very diligently because we are seeing the opportunity that if we can maintain our key relationships in this period of time and we can get deeper in those relationships, we're all going to pick up enormous benefit from those on the backside. Whilst there may be a number of transactions which we can't assist them with right now, by taking them through our process and thinking, we know that we can help to keep those key relationships in place. We're positioning ourselves to take advantage of the small percentage of very appealing opportunities which this market dislocation will present. We've seen a number of transactions which were major bank transactions that still are logical and make sense, but don't take the risk that the major banks are prepared to put into this marketplace. So where things are worth doing, we will consider those and then look to make that position materialise. In the sense of construction, It's been classified as an essential service. It's continuing to operate in support of economic activity. There's millions of jobs which are attached to that directly and indirectly, so the government continues to support it. We're seeing a high level of support from federal and state governments. Any changes that we see there, any legislative changes or anything that we see across the building sites, which we go on every day or every week, we will of course be in contact with the Zagga team and keeping them across that to make sure that we prepare the right strategy attached to any changes in constructions. The focus areas for us are high visibility and interaction levels with our borrowers and key stakeholders. We want to achieve the planned outcome for each investment, and we want to keep close to the market and our consultants. The last piece, which I will touch on, is the areas of opportunity which we believe will come into the market when the timing is right. I stress that the timing is right is the key. Although we may be aware of what we think those opportunities will look like now, we're not here to pioneer markets or take risk on at the early stages. But the areas which we think will have opportunity for us are deal structuring, where we can increase returns without shifting risk. For example, this may include preference equity and success-based fees, joint venture arrangements, syndicate lending, and increased control and oversight with implementation of our preferred teams and consultants. Picking off transactions which are bank-like but not yet approved and committed through the relationship piece, which I touched on earlier. And there's an opportunity for direct asset purchasing to take advantage of market opportunities, which could include things like repositioning assets and realizing on value for future upside, picking up undervalued construction sites and completing the planning and delivery attached to those. I'll be happy to answer any questions you have about this or anything else related to the property industry and what we're currently doing. And once again, I appreciate the opportunity to come and speak to all of you today.
Thanks, Tom. There's a question up on the chat, which I'll just read to you, and it would be good if you can give us an answer.
Sure.
I would love to understand what both valuers and Zagga are doing right now to value property. I am seeing a number of panel valuers declining to now put a valuation price on property, and this situation is of interest to understand LVRs. And if Tom can expand on the comments made in relation to valuers, that would be good to understand further. Tom, do you want to say something about that?
Sure. So we're a member of the Australian Property Institute through our business, the API. The API is responsible for issuing directives to all member accredited valuers. That would include the full panel of valuers which Zagga and every other major lender use. We're also certified property practitioners and valuers ourselves through our business. So what we've been advised and told by the API is that there is a policy which goes inside each valuation. Steve and Alan may be able to share that policy. There's no sensitivity around it, but it's effectively a clause which valuers are using at the moment to continue valuing property pre-pandemic levels with a right to revalue their valuation in a 6-month time window. What we're doing is stress testing each asset and potentially underwriting assets at different values to the valuation. We recognise that in the terms of what a valuation must be with recent and comparable sales, that may not be the current market conditions. So where we need to take an internal view as a technical analysis, we will change that for our lending purposes, and it will reflect in the gearing level against the value which we see as fit, knowing what the actual marketplace looks like from our day-to-day experience versus what a valuer may do under policy directive.
Thanks, Tom. Steve, do you want to add anything to that, just in terms of how we view the valuations, how we discount them? Some comments around that?
Yeah, look, I think it's important that, in this time, there's the valuation and there's the paper it's written on. And in this case, we're never going to go, above that value, and we're certainly going to discount it if we feel there's a need to, like Tom says. We're also, as Tom mentioned, we're not negotiating over leverage. So that might be on the deals where we previously write 65, we're now writing 60. And we're trying to obtain additional assets. And I think in this market, the borrower understands where we stand from the point of view of why we need the additional assets. Just other points, maybe while I'm on here, what I could just say, it's obviously you can hear it's business as usual for us, whilst we're being very conservative. There's the processes there where we're trying to find opportunity. And I think Tom mentioned with what some of the other lenders are doing, especially the bigger ones, it's created a wide window of opportunity for us, where we're seeing a lot of deals that we wouldn't previously see that were being written by La Trobe, where they were offering the borrower 6%, and now it's fallen into our world. And we have the ability to write these loans. We obviously need investors' help on this, but they're definitely there in numbers, and we are being very picky with what we're choosing. As far as the individual loans, I've had questions, will you tell us if a loan goes wrong? Of course we will. We take, I think the biggest thing we take pride in is our integrity and transparency. And thankfully the book is holding up very well. I know Tom made a comment on, the tenancies and deals with commercial assets. I think we really don't have a high exposure to those type of assets, and thankfully, it hasn't shown through in this time, which is just testament to what the book is holding at the moment. That's it from me.
Thanks, Steve. There was one other question that I'd like to deal with. The question was as follows. Due diligence and sign-offs are largely performed by third-party experts. How are these third parties compensated? For example, do they receive the same amount of compensation regardless of their findings or support for a deal? So the answer to that is absolutely no third party of ours participates in the deal in any way. So as far as any valuation is concerned, the valuers charge their panel fees. Those fees are quoted for upfront. They're paid for. We don't give the valuer any instruction other than the normal instructions we want to understand from a security point of view. So in other words, how do they value it? Is it for vacant possession? Is it at market value? What is the value instruction? We don't give them any indication as to value. We wait and see what comes back, and you've heard the other comments around valuation. As far as our solicitors are concerned, exactly the same. We get an upfront estimate of fees for every transaction based on the offer and term sheet. We use a panel of solicitors. We don't use the same panel all the time. The 5 or 6 solicitors on the panel are all specialists around property and banking law. Their fees do change from deal to deal, but they're all within a range. And certainly there is no remuneration based on success or anything like that. The same, by the way, for the CCPA credit team. They get paid a fixed fee to write the credit on the deal. They have absolutely no interest in what the outcome of their deal is. And if they assess the deal as bad or assess the deal as good, they're getting paid for the time and expertise that they put into the deal. The same as I may as well say for Zagga, we are not remunerated based on success or otherwise. We get a fee per deal. That fee is exposed to you and transparently disclosed on our platform in the investment memorandum, as are the fees that are being paid to the QS, to the valuer, to the solicitors, to a broker if there's a broker involved. So everything about our platform and about our business is completely transparent, and we try and give you as much information as we possibly can around that. And certainly you can rest assured that nobody is getting paid to give us the answer we're looking for. And generally these days, the answer we're looking for is no. So we're quite cautious around that. I don't see any other questions up on the platform. So I'm assuming everyone is pretty happy with what they're hearing. We wanted this to run for about 30 minutes anyway, so I think we're almost there. Perhaps I'll just make a few closing remarks. The first one, obviously, is to thank Tom for his input. Bill Blair, our internal credits manager, is also on the call. I haven't really invited him to say anything, but Bill, thanks for calling in. An invitation to any of you to phone us at any time, email us at any time with any questions or concerns you may have. We're absolutely here to answer them. Don't be shy to ask the hard questions. We're happy to answer those too. As you've heard from Steve, there are deals coming through the platform. We understand right now people are a little bit cautious, and that's absolutely understandable. But for those of you, who have some interest and some appetite, hopefully this call and the information you have been given has given you some comfort about the process and the way we go about doing things. But that shouldn't stop you from asking us questions once you get the IMs or anything like that. So just on that score then, to thank you all for your time and your participation. We will send out some notes just in terms of some of the things Tom said. We'll send a note out either today or tomorrow with a summary of some of those high-level items so you have a record. We'll also send a copy of the video around. And just final wishes to everybody to take care, be safe, stay healthy. We'll come up with a new video next week. And if you have any topics that you would like covered, please let us know. But other than that, I'm just going to say thank you to everybody and we can sign off. Thanks and bye-bye.